Hello and welcome to our latest lecture for the online review program. Today we're going to be covering Chapter 9, which is Property, Plant and Equipment, Natural Resources, and Intangibles. So let's get started. First, why is this chapter important and why are long-term assets so important to a business? So there's a cycle of the life of an asset. The first thing that a company is going to do is acquire an asset. So they're going to purchase new assets. Rather than expensing them right away, we need to figure out the cost to capitalize. And we're going to go through what all of this means in later slides. So the first step is we acquire the asset. Then, over the life of the asset, we use it for the business to generate cash or other economic benefits. So rather than expensing it right away, we defer the cost and we allocate it over the life of the asset. So we will learn about the different depreciation methods. After that, during the life of the asset, there may be changes in estimates because depreciation is largely based on estimates of the useful life, estimates on how much we can sell it for later. So this could be on the residual value, the life, it could be a change in the depreciation method. Finally, there is a chance that there may be an impairment of the asset, and we're going to go through what that means later on. But essentially, if we were to impair an asset, we would have to write down the value of the asset. And finally, at the end of the useful life, we would retire or dispose of the asset. And so we might sell it to another company, to another business. So we may actually have a gain or loss on disposal. And at the end of this cycle, the company would replace the asset and start it all over again. So this is just a big picture, macro view of the chapter. So let's start off by discussing long-lived assets. Other terms for it are long-term assets or capital assets. So what are capital assets? Well, they're either tangible or intangible resources owned by a business and used in its operations to produce benefits for several years. So what does that mean? A tangible asset is something physical that you can actually touch, like the table in front of you. Or an intangible asset would be intellectual property, something that you can't actually touch. And it's used by the business for a long period, over a year. So some examples of tangible assets would be land, buildings, equipment, vehicles, biological assets, like if you had livestock for a farm, or natural resources like oil or gas. Intangible assets would be intellectual property like copyrights, patents, trademarks, and more. Or it could also include goodwill. Goodwill is something that only exists when you purchase another company. So it's something that a company cannot generate internally. Goodwill is equal to the purchase price of a company. So if you were to purchase a company, the amount that you're paying for it minus the net assets that you purchased. So if you paid more for the company than the value of its net assets, this would be considered goodwill. Goodwill is often referred to as management expertise or the brand value of a company. A company often has more to offer than just the physical assets of the company. They may have been in business for a long time, and there's more value than just what's on their balance sheet. So let's look at how we acquire assets and learn about the cost principle. So the cost principle is that all reasonable and necessary costs incurred to acquire an asset, place it in an operational setting, and prepare it for use are capitalized, meaning that they're added to the asset account rather than expensed. So for example, when you pay your employees a salary, you expense it. It's not capitalized. But if you were to buy a building, you don't expense it right away. Rather, you would add the cost, everything to acquire, make it operational, and prepare it for use. You add it to an account just for that building, and then over the life of the asset, the cost would be allocated and expensed over its useful life. So these costs would include the invoice price. So this is, how much you would pay for the asset. So the building is $1 million. Maybe there's sales tax on it. There might be legal fees to close the sale, transportation costs, installation costs, title fees, sales commission that you might have to pay to purchase the asset, as well as surveying fees for land. So anything that is required to make the asset prepared for use is going to be capitalized. So when we purchase the asset or we acquire it, it can be acquired in many different ways. The first way is that it could be acquired in exchange for cash. So the journal entry, for example, for a building would be you would debit the building account and you would credit cash. An asset can also be acquired for debt. For example, if you were to get a truck but not pay it over time, you might have a payment plan for it. You would debit the truck and credit a note payable, and you would pay this off over time. It can also be acquired through equity. Maybe somebody is willing to offer land for your company that you're going to use, and you would give up shares for it. So for example, you would debit land and credit common shares. Or it can be constructed and built through your own company. You might build the asset yourself. So you would debit, building. You would credit maybe cash or materials, anything that was used to build the asset. Sometimes a company will purchase multiple assets in one shot, and this is called a basket purchase. It's where you acquire multiple assets, so 2 or more, but for a single price, a single transaction or lump sum. So how do we assign the cost? If we're paying $1 million for 3 or 4 assets, how do we assign it? So what we would do is we would allocate the lump sum amount, so the amount that you paid, to each asset based on its relative market value. So you can actually use this table right here that's going to help you out on your exam problems. So for example, you decide to purchase a building and land for a total of $1,500,000. The building has a fair market value of $600,000 and the land has a fair market value of $400,000. So let's fill out the table together. So the assets we've purchased are building and land. Now let's take a look at the market value. The building has a market value of $600,000 and the land has a fair market value of $400,000 for a total of $1 million. So this is how much these assets would sell for individually. So what you then do is you would divide the market value of each asset by the total amount. So 600,000 divided by a million is 60%, and 400,000 divided by a million is 40%. We would then look at the total purchase amount, which is 1,500,000, and multiply it by the percent to figure out how much we're going to allocate to each asset. So for example, 60% of 1.5 million is 900,000. So that's how much we would allocate to the building. 40% times 1.5 million is 600,000. And that's how much we would allocate for the land. So the journal entries for this purchase would be debit building for 900,000, debit the land for 600,000, and we would credit cash for $1.5 million. What about expenditures that incurred during the life of the asset? So we've already said that anything that's used to prepare the asset for use is going to be added to the asset. But what about during the asset's useful life? Well, there's 2 types of expenditures a company might make. The first would be ordinary repairs and maintenance. Now, these only maintain the asset and don't actually improve it. They don't make it more productive. They don't increase the useful life. This could be stuff like regular maintenance and cleaning of a building. It could be changing the oil on your truck. These are regular expenses they need just to keep the asset as is, and these should be expensed in the period that they are incurred. The other type of expenditure you might have are extraordinary repairs. And these are expenditures that actually increase the productivity, the efficiency, the capacity, or the useful life of the asset. They basically make the asset better for your uses than it was before. For example, if you can make a car now last 10 years for your company instead of 8 years, it's now going to have a better useful life. Or maybe you have a machine that's now going to be more efficient. These are actual improvements to the asset, and they're known as capital expenditures, and they should be capitalized, meaning that the cost is added to the asset account. So rather than expense it, you would add it to the cost of the asset and then depreciate it over time. So on that note, let's talk about the actual depreciation methods that we have. What is depreciation? It's the process of allocating the cost of property, plant, and equipment over their useful lives using a systematic and rational method. Basically what we're saying is we paid X dollars at the date of purchase. So this is day one, and we actually purchased it over here. So we spent cash over here on day one. But what we're going to do is periodically through the life, we're going to allocate the expense of this cost. It's not going to be paid in one shot. Rather, through the life, based on one of the depreciation methods, we're going to allocate the cost. We don't directly decrease the asset account when we take depreciation. Rather, we accumulate it in a contra asset account called accumulated depreciation. Do you remember what a contra asset is from before the midterm? It basically acts in the opposite way of the account that it is countering. So, for example, if an asset increases on a debit and decreases on a credit, a contra asset would increase on a credit and decrease on a debit. And the only reason it exists is to decrease the value of the asset account it is attached to. And then on our balance sheet, we would show the carrying amount or book value of the asset. The carrying amount or book value is the cost of the asset, so what we initially paid for it plus whatever we added when we capitalize extraordinary expenditures, less the accumulated depreciation we have taken over its life. But please note that the book value of the asset does not represent the current market value. The current market value can be completely different from the book value. And on our balance sheet, we would show the asset as such. So for example, if we had a building, we would show the building at cost. So this is at cost. We would then write less accumulated depreciation, and we would then put the net amount for the building. And this is the carrying amount. So the journal entries to actually record depreciation would be such. Since it's an expense, you would debit it. So you debit depreciation expense, and we would credit accumulated depreciation. And what we would also do is just put a little dash and write the name of the asset account. So this could be, for example, it could be truck, building, it could be equipment. Whatever the account being affected is would be listed there. And we already showed what it would look like on your balance sheet. If you remember, just the asset less accumulated depreciation gives you the asset net. So a couple of terms you're going to need to know to actually calculate the depreciation expense is the acquisition cost. So this is the cost of the asset. So generally an accounting problem will start off by asking you to figure out what the acquisition cost is, and you're going to have to add up everything that would be capitalized. Then you would have to know the estimated useful life. And this is the estimate given by the management on how long we're going to use this asset for our company. And you're going to have to know the residual or salvage value. And this is how much we think we could sell it for at the end of its useful life. Once you have these, you can start to calculate the different depreciation methods. So the first method we're going to talk about is the straight line method. And this depreciates the asset on a consistent linear basis. So for example, if you were to have the carrying amount of the asset here, if you remember, the carrying amount is cost minus accumulated depreciation, and this would be time in years. This is what it would look like. It would be a straight line, and every year we would be depreciating an equal amount. And so the formula for this is the cost of the asset less the residual value, and these two, so the cost minus the residual value, is known as the depreciable amount. It's how much we're going to depreciate over the life of the asset. And we would then divide this by the estimated useful life in years. So essentially, this is going to it's going to depreciate the asset by the same amount every single year. It's consistent. The next method would be the units of production method. And similar to the straight line method, you start off with the depreciable amount, so the cost minus the residual value, and you divide this by the estimated useful life in units this time, not in years, in units. And you then multiply this by the actual production in units. So if you didn't produce anything this year, you would not depreciate the asset. So what would this look like if you had the carrying amount and you had the time or the life of the asset? One year you might depreciate it a lot, the next year you might not depreciate it at all, the next year just a bit. And this fluctuates year by year based on how much you actually use the asset. And finally, we have the declining balance method, often known as the double declining balance. That's because the most commonly used one is the double declining method, but it could be a triple or quadruple declining balance method. So the double goes right over here, but if it was the triple method, it would be a 3. If it was a quadruple, it would be a 4. So you take that, the 2, divide it by the estimated useful life in years. So if it's going to last 4 years, it would be 2 over 4. And you multiply this by the current carrying amount of the asset. So on day 1 of the asset, the carrying amount will be equal to the cost. And over the life of the asset, this carrying amount will decrease as you depreciate it further. So what this method does is it depreciates the asset a lot in the earlier years of use. So it would go down a lot, and then year by year, it's depreciating less and less as the carrying amount that it's being depreciated through is decreasing. Now, which of these methods is the best? Well, it depends. What you're trying to do is make the depreciation method as realistic to your actual operations. You want it to be reflective of the operations. So the double declining balance method can be very useful for assets that are used up quickly, stuff like tech that becomes obsolete very quickly. The units of production method could be very useful when you're talking about vehicles or trucks that drive a certain amount of kilometers every year, or maybe a machine that can produce a certain number of units over its useful life. And maybe some assets like a building, it would be better to use the straight line method because you would consider that it might depreciate equally over its useful life. But remember that these are all estimates and that they can change. They're all estimates. They're not identical to what the market would consider it as being worth. So how do we deal with a change in depreciation estimates? Since it might change over time, we would calculate a new depreciation rate going forward based on the current carrying amount. So let's say the current carrying amount was $800,000, but the cost was $1 million, and your accumulated depreciation was 200,000. What you would do is you would take this carrying amount and you would use this as a new base or depreciable amount to calculate your depreciation going forward. We're not going to go into this in depth right now, but if you look at past exams or you look in your textbook, there's many examples of how to do this. Let's look at how we would deal with the impairment of assets. So corporations are required to test the carrying amount of their assets. So remember, carrying amount is equal to the book value, which is equal to the cost minus accumulated depreciation. So they need to test the carrying amount of the asset, both tangible and intangible, for possible impairment every year. So when we test for impairment, we look at the carrying amount and the recoverable amount of the asset. And actually, this is a mistake here. This should say greater than. So impairment occurs when the carrying amount of the asset is greater than the recoverable amount. The recoverable amount is the greater of either the asset's value in use or the fair value less cost to sell. So the whole idea here is that you don't want to show the value of the assets as being higher than they're actually worth. Remember that capital assets are a major expenditure for companies. They're a huge chunk of many companies' balance sheets. So when users of financial statements and investors are looking at companies, they would assume that the asset is worth more than it actually is if the carrying amount was greater than the recoverable amount. And we don't want to be deceptive to the users, so what we have to do is we have to write down the asset. So when the carrying amount is greater than the recoverable amount, you have to recognize a loss. So you would write loss on impairment of assets. So this could be, equipment, could be a building, it could be anything at all, any asset that you might have, any capital asset, and then you credit that assets account to bring it down to the amount of the recoverable amount. So let's talk now about how we actually dispose of property, plant, and equipment. At the end of the useful life of the asset, the business may dispose of it voluntarily, or they might dispose of an asset involuntarily. So if there was an accident or a fire or a storm and the asset was destroyed, they would dispose of it. Now recall that the book value of the asset does not equal the fair market value of the asset. So when we dispose of the asset, we might actually receive a cash consideration that is higher or lower than the asset's book value. If it's higher, so for example, if we get more cash than the book value, we recognize a gain. If the cash we receive is less than the book value, we would recognize a loss. A gain or loss doesn't mean that the company actually receives money or doesn't receive money. A gain is just the amount by which the cash consideration or the consideration received for the sale of the asset exceeds the book value. And if the cash was less than the book value, the amount by which it is less than the book value is equal to the loss. So if you look here, the cash received minus the carrying amount gives you your gain or loss. So if it is a positive amount, it is a gain. If it is a negative amount, it is a loss. So when we dispose of the asset, there are two steps you have to take. The first one is depreciate the asset up to the date of the sale. If you're already at your year end and you've taken depreciation for the year, you can skip this step. But if you haven't taken depreciation yet, you have to take depreciation up to the date of that sale. Now, if it's halfway through the year, you would take your annual depreciation expense and you would prorate it, meaning you multiply the depreciation expense times the number of months that have passed over 12 months. So you proportionally allocate, you prorate the amount of depreciation expense based on the number of months that have passed. Once you've taken depreciation up to the date of the sale, you then record the sale of the asset itself. and 4 accounts will be affected when you do so. So let's take a look at what it would look like. So the 4 accounts that are affected are cash. Remember, you're receiving cash for selling the asset. Accumulated depreciation, because you want to clear it off your books when you clear the asset. The actual asset itself would be removed, and you would have either a gain or loss if it was sold for a higher or lower amount than the book value. If you sold it exactly for book value, then there would be no gain or loss. So if you dispose of an asset with a gain, you would debit cash because you're receiving cash. You would then debit accumulated depreciation, the part that is related to your specific asset that you're getting rid of. You would credit the asset itself at cost to get it off your books, and you would credit a gain. And often during a problem, you can do this last. You can just plug in to figure out what the gain would be. Because remember, your debits and your credits always have to add up. If you're disposing of an asset at a loss, you debit cash, you debit accumulated depreciation, but you would also debit a loss on disposal. And then you would credit the asset account. And as you go through problems, you're going to get a hang of this, and it's going to get a lot easier. Let's take a look at the next part of the chapter, natural resources and intangible assets. So what is a natural resource? A natural resource is an asset that occurs in nature. So for example, mineral deposits, timber, oil, gas. And instead of depreciation, we would actually recognize depletion of a natural resource. So this is the systematic and rational allocation of the cost of the natural resource over the period of exploitation. So for example, you have a company that has an oil reserve, and over the year you develop it for $1 million. So you develop the oil reserves and you build an inventory. So you recognize the depletion of the reserve by debiting your oil inventory for $1 million, and you credit the oil reserves for $1 million. And this records the depletion. It shows somebody looking at your balance sheet that your oil reserves are going down as you develop these natural resources. We also have intangible assets, and these are becoming increasingly important for companies as our economy changes. Think of how important manufacturing was over here 50 years ago versus companies today that may not have many tangible assets. Think of a company that recently did their IPO like Snapchat. Snapchat is worth billions of dollars, but they don't have many hard assets. Most of their assets are intangible. Think of software companies. These companies can be worth billions of dollars without having any factories or many buildings at all. Most of their assets you can't physically touch because it is tech-based or software-based. Intangible assets are often only recorded at historical cost when they are purchased, because internally developed intangible assets can only be capitalized in some cases. In most cases, R&D, so in most cases, it is expensed. There are cases where you can capitalize research and development costs, and I recommend you look at your book if you're interested in learning how this works. There are 2 types of intangible assets. There's definite life intangibles and indefinite life intangibles. A definite life intangible is one that has a useful life. It is not going to last forever. And this asset will be amortized. So amortization is similar to depreciation. So it is amortized over its useful life. An indefinite life asset is one that does not have a useful life. It lasts forever. It lasts indefinitely. And an indefinite life asset is not amortized. But you must still test it at least once per year for possible impairment to see, is it still worth as much as we think it's worth? If there is impairment, you would have to then write it down. So let's talk about some different types of intangible assets. So the first intangible that we're going to talk about here is goodwill. If you remember, this is the amount that you pay in excess for a company more than its net assets are worth. So goodwill is equal to the purchase price of a company minus its net assets. Net assets is the total assets minus the company's liabilities. So the purchase price minus the net assets is goodwill. And you'd pay extra, remember, because of the management expertise, because of their brand, etc. A trademark is the legal right, so it is the right to use a name or an image or a slogan. A patent is granted by the government, and it gives the inventor or owner of the patent the exclusive right to manufacture or sell a product. So think about it. If you invented a product, you would be incentivized because you would have the exclusive right to sell this for the life of the patent. And in Canada, it's generally 20 years for a patent. A copyright is the exclusive right to publish, use, and sell music or artwork. So the right to use or publish music, artwork, to use a book or literary pieces. A franchise is the right to sell products, services, or trademarks. So popular franchises are, McDonald's, Tim Hortons. These are popular franchises. So you would go to the parent company and you would pay for the right to operate your own Tim Hortons or McDonald's. Technology would be stuff like software, web development, anything like that you would use for your company. And licenses are the rights to use public property or the license to perform a service. So you can look at all this and you can see how important this would be for many companies today. Since manufacturing companies are not as predominant here in North America anymore, intangible assets are actually super important for most businesses today, even ones that are manufacturing companies. So it's important to consider this when you're learning this chapter and in general in your business career. And finally, we're going to look at one ratio today, and that is the fixed asset turnover ratio. So the fixed asset turnover ratio is the net sales of a company divided by the average net fixed assets. So if you remember, average is the beginning and ending balances divided by 2. And the net fixed assets, well, you can look at the balance sheet to figure out how much that is, and that's going to change year by year. So the whole point of the fixed asset turnover ratio, if you think about it, it is the sales of the company divided by their assets. And what this does is it measures how efficiently the company management is using the assets to generate sales. And this is really important. Remember, assets can cost tens or hundreds of millions of dollars, and you want to use them efficiently to generate as much cash for your business as possible. So I'm going to give you 2 good examples of where companies are trying to use their assets to generate as much cash as possible. So the first one, I'm going to give an example of our own school, JMSB or Concordia. So think of the Molson building or any other building on campus. The buildings cost a lot of money, and the school wants to use it to generate as much revenue as possible. Remember that during the summer, there's a lot of downtime. The building isn't being used as much. On evenings, the classrooms may not be used. On weekends, they're not used as much. So the school might look into ways to maximize the assets they have. So they might rent rooms out to outside parties. They may offer additional programs, anything that they can do to take advantage of the capital assets that the school has to generate more revenue. Another very good example is airlines. Airplanes cost a lot of money. They cost a lot of money up front, they cost a lot of money to maintain. Every minute that a plane is on the ground is a waste of an opportunity for an airline to make money. So what airlines try to do is they try to minimize downtime. And if you look at the most successful airlines, you'll see that the ones that succeed the most are the ones that can use their airplanes to generate as much cash as possible. And if you're actually interested in reading more about this, I'd recommend you read more about Southwest Airlines in the US that really pioneered a lot of this innovative ways to keep their planes in the air and to generate as much cash as possible. So that'll be it for today. We wish you the best of luck and let us know if you have any questions or comments. Thanks so much.